Hi, I'm JC XUE, Portfolio Manager at Foord Asset Management, and today I'll share with you more thoughts on how we are thinking about the recent regulatory issues happening over in China. So the Chinese authorities have tightened the regulatory environment significantly over the last year, rolling out new measures to improve governance oversight across high-profile industries. Prominent examples are the new antitrust rules for tech companies, which resulted in fines for dominant players like Alibaba, and rules to turn the for-profit tutoring industry into non-profit. The market certainly seems to be pricing in fears for the investability of the Chinese market, given the rising regulatory risk. But let's take a step back to dissect what the Chinese leaders are communicating through these regulations. They want to correct market failures that have unintended social consequences which are detrimental to the nation's long-term development. As a command economy, the authorities can act quickly to improve areas of previously weak or immature regulation. The antitrust regulations targeting tech platforms, for example, were to eradicate monopolistic behaviors such as exclusivity contracts and predatory pricing. These anti-monopoly rules are aimed to reduce rent-seeking behaviors of dominant tech platforms. The purpose is not to shut them down, but to regulate them. The authorities want to promote fair competition to allow the next generation of innovators to emerge and not be gated by the monopolistic behaviors of existing market leaders. On the other hand, regulations banning companies that teach school curriculum from making profits, raising capital, or going public have noteworthy social goals. Aside from extreme pressures on students, the financial burden on parents has been rising rapidly as the tutoring industry raised prices on soaring demand. The increased cost of having a child was starting to impact birth rates and adding to China's demographic headwinds. The government needed to tackle this issue resolutely to ensure China's long-term competitiveness. These policy changes have increased investment uncertainty in the short term, but in the long run, the results of these regulations should drive healthier economic development, helping China towards its goal of common prosperity. The government wants to build a stronger middle class, to advance innovation and get stronger as a nation. The objective is not to reject a market-driven economy. In fact, the government continues to view vibrant private enterprise to be the most effective way to drive innovation, wealth creation, and thus fulfilling its common prosperity goals. But private enterprise need rules and regulations to level the playing field and to have bad actors weeded out of the market. Foord has held a positive view on the rising Chinese middle class and corresponding consumption growth. This thesis is aligned to Chinese government's goal of common prosperity and a stronger middle. In fact, core fund holdings like JD.com and Tencent have always created positive value across its ecosystems. JD.com has used economies of scale to provide everyday low prices for consumers since inception. Tencent has been criticized for under-monetizing its assets and continues to give more value than it takes, more recently through WeChat mini programs. Companies that build their business through treating customers fairly and innovating through healthy competition over monopolistic practices are going to thrive in the long run. And both JD and Tencent fit this mold and should experience robust long-term earnings growth in an environment of healthier competition. Still, each has seen its share price impacted by the regulatory action. In the Foord Global Equity Fund, we opportunistically added to our existing holdings and initiated positions in some others that fell to attractive valuations. Finally, we remain optimistic of China's long-term growth trajectory. This round of regulations serves as a healthy reminder to tech platforms to compete on value creation instead of monopolistic behavior. It provides a more conducive environment for new business innovations to flourish, and we're excited to discover the next JD, Alibaba, and Tencent.